My name is Tom Carell. Welcome, everyone. We're glad you could join us this morning for Housing Development Finance and Public-Private Partnerships. This webinar is being provided through EPA under its Technical Assistance Task Order. Emma, I know there's a few housekeeping items, and I'll hand it over to you.
Great, thank you. Hi, everybody. So just very quickly, as some people have already been doing, please use the chat pane for any questions. I think if we get towards the end of the presentation and have some extra time, then we'll ask people if you have any additional questions. You can feel free to raise your hand and we'll unmute you. You'll notice that your microphone and camera by default are turned off as of right now. That's just to reduce any background noise or potential interruptions to Tom as he presents. As always, please use the chat pane if you're having any technical issues or questions for the presenters. Thanks, and then I'm going to turn it over to Brittany from EPA.
Yes, thanks. Hi, everyone. Good morning and welcome, and thanks for joining our training today. My name is Brittany Nadler. I'm a Brownfields Project Manager with US EPA here in Region 5. And I've also been managing this technical assistance project that Tom mentioned that this training was born out of. And so before we get started, I just wanted to give a little background on what technical assistance is. It's a separate pot of funding that we have within EPA. It's not a grant, it's not a competitive process. It's funding that's kind of up to our discretion on how we want to use it with our communities and in partnership with consulting teams like Adapta and Tetra Tech. And so we've actually been working on a technical assistance project with 2 counties in Michigan, and we're focusing on an affordable housing market analysis there, and then this training, and we also had one yesterday focusing on brownfields basics. And these technical assistance projects can really be a wide array of things, ranging from funding shreds, environmental action planning, market analyses, and trainings like this one. And so about 2 weeks ago, the Adapta team put on these trainings for the counties in Michigan, and we got some great feedback, and now we're opening it up to a wider audience. So I'll share some links in the chat if you want to learn more about technical assistance and land revitalization at EPA. The slides for this presentation are available on our website, and soon we'll have the recording for today's webinar and yesterday's Brownfields 101 webinar also on our website. So I'll put those in the chat, and I will turn it back over to you, Tom.
Super. Thank you, Brittany. So I'm going to just dive in here and first review some of the goals for our training. To start things off, we're going to talk a little bit about the housing challenges we're facing nationally. And I know over the course of my career in 25 years, this is a period of time where the issues of housing affordability are probably getting more recognition in the popular press and the business press than they ever had previously. In many communities, public agencies and nonprofit developers play a critical role in helping to fill those gaps in housing affordability. We're going to talk a little bit this morning about how those funding gaps to create that affordable housing can be filled, and then we'll go through some of the state and federal funding resources for these kinds of developments. And as Brittany mentioned, the PowerPoint presentation, the information you're going to see is available on the regional website, and we'll be sharing that link. So to begin with, wanted to talk a little bit about just setting the context for the housing challenges we're facing, and these challenges can be seen through the lens of different causes that are impacting the housing market. First of all is an inadequate supply, and a lot of this ties back to the collapse of the housing finance market in 07, 8, and 9. And it took a number of years after that period of time for the production of housing, particularly single family, but even multifamily, to return to its prior levels. And that's created ongoing supply challenges in many markets. That supply challenge has fed into cost. And in addition, there's been a lack of labor, a lack of construction labor, and that has continued to hamper the ability of the housing industry to meet those demands. In addition, in many markets, the cost for development, land acquisition, the time involved in permitting and approval to get housing development projects launched further exacerbates that supply problem and drives up cost. And then in many markets, in order to get a financial return, the only housing that's viable is the upper end of the market. And so any housing that's more affordable, even for folks that are making as much as 100% of the area's median income or above, they're still overburdened in terms of the cost of their housing, whether that's owner-occupied housing or multifamily housing. And that is driven in part by the need for financial return. The investors that are involved, the banks, lending institutions, equity investors are looking for a certain level of financial return. And to get that return, it's creating a cost structure that's making it unaffordable for many working families. So let's talk a little bit about inadequate supply, and we've got a broad range of communities represented on the call today. And so these challenges will vary from place to place, but particularly in smaller communities or in some of our more challenged lower income neighborhoods, there's a lack of development capability, knowledge of how to use these programs, and the capacity to actually execute on these developments. Another major challenge is access to land, or the ability to redevelop existing housing. All of that is further hampered, particularly in this growing interest rate market, by access to capital. So we're seeing, particularly in smaller communities and second-tier markets, a lack of available funds for renovation of existing housing. There is a higher perceived risk among capital sources for smaller communities and many lower income neighborhoods, even within larger metropolitan areas. There is inherently a different return on investment profile for housing that meets those workforce needs. And often there's a lack of investor capital available to bolster that supply of workforce housing in these markets. And we'll talk in more detail about how some of those challenges can be mitigated in some of the resources that are out there a little later in the presentation. So another major contributor to the housing challenge that we're facing are development cost and timelines. Some of that lead time is involved in site acquisition, and unless developers got the ability to acquire land or control it for an extended period of time until they can get permits, planning, zoning, and building permit approvals in place, then it's a challenge for them to execute. Development timelines are particularly long. Many of the sites that could be good targets for development face infrastructure challenge, from basic utility infrastructure to transportation improvements to stormwater management systems. And when the cost of that infrastructure is added to the overall project cost, it's limiting the ability of some projects to move forward because they just don't generate the return. The sites are too expensive. And as I've already mentioned, permitting site plan approvals. In some communities, those long lead times can be a challenge. And we're going to talk about all of these factors later in terms of the role that both public and nonprofit agencies can play in mitigating some of these factors and increasing housing production in your community. So the third factor I'd mentioned is the financial return. And in many communities, we'll see even insufficient market rate rents. So you're seeing in, particularly in mid-size and rural communities, the simple cost of building the housing, of dealing with those side issues, means that there's a level of rental income needed on the multifamily side that outstrips the ability of the market to pay those rents, or would leave a family kind of rent burdened in terms of having to pay more than 30% of their household income just to find an apartment. So in today's market, what we've seen over the last 6-8 months now, and all the indications of interest rates, so that reduces the amount of mortgage financing available, makes the project overall more expensive. And the only way to overcome that on the multifamily side is through greater rents or through a higher sales price because of the cost of construction period financing for most developers. Another factor can be, the capacity of home buyers to afford the mortgage on that more expensive home. And that can be another factor that just limits demand. And this is because there's a lack of equilibrium between what the market can support in terms of rents and sale prices and the actual cost of those homes, just not providing that return to the investor. Another one of the challenges that doesn't impact all communities, but in some places, even that finished new home will not appraise out for the sales price that the developer is hoping to sell it for. And if the developer doesn't have confidence that their finished home is going to meet that appraised value, they're going to look for another site or look for another market to make that investment. And so that can be a challenge in some areas as well. And this impacts not only new construction, but the renovation of existing housing. So in some communities, even communities we've worked with in the past year, we see a significant supply of older housing, multifamily and single family housing, but the renovation costs to get that housing back into better shape and make it more appealing to folks outstrips the rent that can actually be charged in the rental units or the sales price that can be charged. So it's impacting not only new construction, but existing properties as well. And all of this ultimately comes down to an investor's ability to see a reasonable return on investment in light of the perceived risk and time involved in the project. So I've spoken about these three factors independently, but the reality is they all work in tandem. So the lack of existing housing supply is creating a lot more demand. The challenges of finding the available construction workforce to actually execute on that housing then in turn drives up development costs, and all of that diminishes financial return. And what we end up with is a gap between what workforce housing can actually pay. That is the lion's share of the folks that are even teachers, firefighters, police officers, nurses in your local markets. What they can reasonably afford to pay for housing is less than what the cost is to create that housing. And there comes the gap that we need to grapple with. So what we're going to talk about next is the role of public agencies and nonprofits in addressing this need. And while I've spoken broadly about this challenge, you need to look very closely at your local housing market and understand at a fine-grained level of detail what those housing needs are, the extent to which they're multifamily or single family, and specifically what the wages of your workforce and of your community are and where the needs exist so that you can target your efforts. And defining those income levels is really crucial because the income levels of the families that live in that housing have a big impact on what funding tools are available to you and what the reasonable price is for both rent and sales. That all gets to where the demand exists. And then you need to look, kind of clear-headedly at the challenges your own community faces. Is it the inability to assemble land at a reasonable price? Is it the lack of infrastructure? What are the factors that are most impacting that? And then as either a public agency or as a nonprofit, to think, again, very, clear-headedly about what is the capacity my organization has to tackle those factors, Do I need to engage consultants? Do I need to engage outside expertise? Or if I can do this with my own staff through the right program funding, what is the role I can best play? What's the best role my agency can play in a community to tackle these challenges? From that standpoint, you can then put together a strategy that is very clearly articulated. And to the extent you're trying to build public consensus, which is a critical part of any of these efforts, to bring other funding resources together, you need to be able to articulate that strategy to your communities, to your stakeholders, so that everybody understands the reason we're expanding water and sewer capacity to these sites, the reason we're putting in new electric infrastructure and dealing with stormwater issues is so we can create that housing and people understand the linkage between those factors, which often isn't clear, to the average citizen out there. With the clarity of the strategy you're going to implement, then you can really zero in on the funding resources. And we'll talk about some of the different funding resources that are out there, as well as the role developers can play in this process. The end result is that helps to catalyze development. And what we're seeing really across the country is that in the absence of having leadership on the policy side to take tangible steps in tackling some of these issues, workforce housing, affordable housing just isn't going to happen in your communities. And that's going to continue to drive up cost across the market because of the supply issues. So, as I touched on already, we talked about some of the challenges, whether that's land cost, the lack of buying power of home buyers, lack of capital or expertise in your market. The roles agencies can play are kind of listed out here. You can put land together. You can undertake some of that early stage site development. You can assist with orchestrating subordinate debt. And we'll talk a little bit more about funding and financing structures. But in order to make most of the workforce housing transactions, affordable housing transactions work, there's very often a level of subordinate debt. That is lending that occurs below the hard first mortgage from a conventional lender. This is where public funding sources come into play. And then on the for sale side, often there's tools in place to reduce the sales price. This is the same kind of structure that organizations like Habitat for Humanity utilize. The house may cost $150,000 to build. The homeowner can only afford $120,000. There's a subordinate mortgage for that $30,000, and it's bringing those additional resources to the table that help make those transactions work. If you're able to tackle some of these issues, one of the strategies you then may want to pursue is issuing a developer request for proposals, and that is actually seeking developers to come to your community, developers that have got experience in working with some of the funding programs that we'll be talking about in a few minutes, who have knowledge of how to structure these transactions. But to track those developers, you need to remove the impediments in your marketplace and bring resources based on what those challenges are to the table. So of the funding sources that are out there, and one of the things, again, nonprofits, community agencies, public sector organizations can do is to provide some of the early stage capital that's needed to catalyze these developments. So as I've already mentioned, those funds could go into site acquisition, assembling parcels of property, doing all the title work and those kinds of things to bring to market a site that's ready for development. And some of that could even include early stage entitlement or rezoning if it's necessary prior to issuing a developer RFP. Another one of the costs in many areas that makes that new housing development a challenge is either the lack of infrastructure, could be aging infrastructure, could be a lack just of capacity. There could be stormwater management capacity issues or water supply issues. Getting some of that basic infrastructure in place so that you've got a site that's developable from an infrastructure standpoint, but also a site that's environmentally clean. And so doing phase one investigations, considering, we talked about some of this in yesterday's presentation, acquiring existing brownfield properties to facilitate the redevelopment and looking at the environmental cleanup and the resources that are available to support that. So when you go out with that developer RFP, you know that you've got a site that's environmentally clean. You've looked at the geotechnical and soil structural issues that might need to be addressed. You've looked at stormwater management, utilities. All of that is going to shorten the timeline that a developer has to endure from the point they get a fully permitted set of building plans to when they can actually start construction and place the property in service. So the investment and bringing these funding resources to the table, as much as it helps on the cost side of the transaction, it also really helps shorten that development timeline, and that improves the return on investment overall. Some of the other tools we'll talk about in a little bit are the permanent mortgage financing tools. And there's been some changes in some of the federal programs, particularly around workforce housing, and particularly in today's escalating interest rate market, some of the federal residential mortgage insurance products are really critical to making these deals work. There we go. Sorry, I had a little freeze up on the slides there. So in terms of catalyzing that development in your community, and I touched on this briefly, but it really is critical to get community input and to build consensus around the approach that you're taking in order to tap into most of these funding resources. There's very often a local match. The federal programs are not going to provide 100% of the financing. And that means you've got to have the local political will to dedicate resources to an initiative like this. This is where having clarity about the role your organization is playing, how that role is going to then catalyze development, how that's going to help the community. And increasingly, what we're seeing is that there's a lot of support coming from the business community because of their need to attract and retain workers. And in the absence of that affordable housing, the ability even to recruit teachers, first responders, nurses, even physicians in some markets, there's a need to provide additional housing resources. And so we're seeing a recognition from the business community that housing is critical for their business operations as well. And I've touched on many of these things, but the idea is that if you've got clarity about your strategy and how your organization can support housing, the role you're going to play, then you will be much more effective in being able to issue a development RFP. And then the next critical step is structuring a development agreement that defines roles and responsibilities. And also, in the public's interest, if you're using public dollars to accomplish this, that there's an equitable return on investment, so that if there are subordinate loans on a property, if there are public resources being brought housing development work, that there's clarity about what the return on investment can be and that somebody's not being unduly enriched through these resources. So one of the most critical factors here is this early stage capital. And I, again, touched on this already, but developers are reluctant to come to sites or communities where there's a significant lead time to get a project approved, where there's significant work in site, environmental remediation costs in order to get to a buildable site, because that adds both to the cost and the time required to get that housing development off of the ground. So the role that public agencies, nonprofits can play is by shortening that development timeline so that it is not on that private developer's shoulders. It's also going to make your community much more competitive in the ability to track that outside investment. And it's that early stage risk that's the greatest from the developer's perspective, because there's not certainty that they're going to have the investment capital, have the permanent mortgage lined up and all those details until they're much further down the road. And if you add to that timeline the need for extensive site development costs and infrastructure, developers are going to go to the path of least resistance generally. So it's about kind of reducing those roadblocks to attract that capital. Another critical role that communities can play is supporting construction stage financing. That can be done through interest rate buy downs, through capital deposits. It can be accomplished by providing public sector financing for a portion or potentially even all of the construction work. And there's ways to ensure that that is as low a risk loan as possible by securing your permanent mortgage financing on the front end, so that you know once the project is built, you can bring in the long-term, more attractive interest rate money to the project. But construction period financing is, and the cost of that, again, particularly in our current environment, is going up and can present an overall challenge. So it's one of those places where you can reduce the project costs. And then, as I've already touched on, subordinate debt. And this occurs both on the rental side of development, which can be permanent subordinate debt on a multifamily property that's paid back with cash flow and would get refinanced only upon sale. And it also exists in the for sale side in terms of either a purchase price write down or subordinate debt funding for the acquisition of the house. So I've been talking for quite a few minutes. We're at a good point in the presentation. The next part of the presentation, we're really going to dive into the financing resources. And so if you've got any questions, this would be a good point for us to just take a moment, maybe put your questions in chat. Or if it's a long question, I guess you could raise your hand and we'll take questions for a couple of minutes. Dive into housing funding resources, the financing tools that are out there. And we're going to talk both about state sources and federal sources. The icons that you see here, these are all of the housing finance agencies represented by the states served by the CPA region. So you should see your housing finance agency's logo there. We're also going to talk about the role HUD and USDA can play in this, as well as the state environment departments, which bring other environmental funding resources to brownfield redevelopment. And as we touched on briefly yesterday, a brownfield doesn't mean that a site absolutely has environmentally impacted conditions or recognized environmental conditions on the site. It could be that you don't know. It's a vacant or abandoned property, and those resources can be brought to bear to help with assessment costs and if you find issues with the cleanup of those costs. So begin first by talking about some of the federal funding resources that are out there. This is just a real quick overview of the things we're going to touch on. I'm going to briefly talk about LIHTC, home funds, National Housing Trust funds, the mortgage insurance programs, as well as project-based rental assistance, and then the USDA programs. Another category of funding that can help support housing development are community development block grants, the USDA rural development, community facilities programs, as well as the EPA programs. Those are often best suited to help with site development, with infrastructure development, and remediating site conditions, both geotechnical and environmental site conditions. It's a low-income housing tax credit program. This is going to be a very brief review of the program. Hopefully some of you all are familiar with it. The LIHTC program is a federal tax credit issued through the Department of Treasury, and the way the tax credits are funded is that the Treasury makes an allocation to the designated state housing finance agency in each state. That state, every state's required to do this, is create a qualified allocation plan, and that plan describes the priorities for each state in how those credits are going to be allocated. So it's a competitive process. Most states have a couple of rounds of funding each year. There are two types of credits, a 4% credit and a 9% credit. I'm not going to go into all those details, but suffice to say that the credits that come from Treasury go to the State Housing Finance Agency. Developers compete for an allocation of those credits. And if their project is awarded housing tax credits, they can then sell those credits to an investor who has a federal tax liability. Increasingly, the buyers of those credits have been insurance companies, large financial institutions, or investment funds that are purchasing the tax credits. And the tax credits flow over a period of 10 years. And the investor will pay, in today's market, about 85 to maybe 92 cents on the dollar, depending on the project. And they'll pay that, let's just say 90 cents for $1 worth of tax credit. They get those tax credits allocated over a 10-year period of time, but they fund their equity up front. So it's a time value of money calculation. The equity investor pays a premium on the front end to put their equity into the transaction. They get tax credits over 10 years, and that equity is basically new dollars coming to the transaction that don't cost the developer anything other than the cost of putting the tax credit application together and meeting the compliance requirements, and it generates millions of dollars in equity. We'll talk about a couple of examples of demonstrating how much equity those kinds of LIHTC transactions can bring to an affordable housing development. One of the other biggest programs out there is the Home Investment Partnership Program. There's a link here that will talk about the program in more detail. You can go to that link. If you live in a larger urban area in an entitlement community, your city will receive, like the city of Chicago receives, an allocation of home funds. If you're in a smaller community, that allocation goes to a state agency, and the state agency then in turn awards those funds to projects. There's a competitive process for those funds. It will fund housing for households up to 80% area median income, both rental and for sale housing. And as it mentions here, it can be used for a variety of things, from loan guarantees to direct loans to subsidy payments, very flexible. A newer program that's only been around for a few years is the National Housing Trust Fund. Again, there's a link to this here. A lot of flexibility in this program. A minimum of 10% of the money has to go to for sale housing. 80% goes to rental housing, and then there's the rest of it's in administrative cost. And there is a requirement very similar to the housing tax credit program for a period of affordability. And the Housing Trust Fund dollars bring with them a 30-year affordability requirement. And just by example, a couple of years ago, it's more now. They don't have the numbers out on 2022 yet from what I looked at last week. But in 2021 put out almost $700 million in funding nationally to support housing. So one of the other really important tools out there, and unless your agency is an active housing developer and you're playing the role of developer, these are not programs that you would tap into yourself, but they are programs if you're issuing a developer RFP, if you're out looking for developers to help create workforce and affordable housing in your community, you should be asking them about their ability to work with these programs, their knowledge of these programs. It provides longer amortization, lower interest rates. All of that reduces the amount of debt service and improves the affordability of housing. So we'll talk a little bit about some of these programs. After 2009, as part of the restructuring of Fannie Mae and Freddie Mac, Housing Finance Agency, there's three entities under that: Fannie Mae, Freddie Mac, and the Federal Home Loan Bank. Both Fannie and Freddie provide government-insured mortgages on multifamily and on single-family homes. On the single-family side, they will acquire mortgages originated by private lenders. They've got programs targeted for sale housing to serve lower income and workforce residents in those housing developments. And there's an underwriting process to tap into these programs. They provide the commercial mortgage lender with a mortgage insurance product. So if there is a default on the part of the developer or the property, if it were to declare bankruptcy or go under, that mortgage insurance provided through Fannie Mae and Freddie Mac stands behind the mortgage. And the exchange for that guarantee is the lower interest rate and the longer amortization. So the bank doesn't see as high a level of return as they might from a shorter term, higher interest rate loan, but it's backed up by a government guarantee. And so it's a more solid asset in their bank portfolio. Again, all of this drives down the cost of those mortgages. And I went to the next slide, but I want to say one other thing, and that is that there are new programs through Fannie Mae and through Freddie Mac that provide incentive rate funding, that is even further reductions in interest rate and longer amortizations for workforce housing. And that is housing where at least half of the units in a multifamily development are designated for families at or below 80%. So that's a higher level of income than the tax credit criteria, which is at 60% of the area's median income for the families and residents that live in that housing. What you'll find in many communities is that if you look at the entry-level wages for nurses, teachers, a lot of folks that are critical to your community, to say nothing of our service workers and, hotel hospitality, they're making at or below 80% of the area's median income. So this isn't housing for the poorest members of our community. It's truly housing for the workforce that we need. One of the other programs that's out there is the Federal Home Loan Bank System. This EPA region has 4 different home loan bank systems represented: Des Moines, Chicago, Indianapolis, and Cincinnati. Those are regional banks. They're funded through the federal government to create depository funds. Here's a list of those banks, links to their websites. The reason they're important is that all of these banks have an affordable housing program. They're required by Congress to contribute 10% of their net income to affordable housing. They make regular grant awards and investments in community development programs. They also provide that secondary mortgage, similar to the way Fannie and Freddie function, but without the mortgage insurance. They're buying homeowner mortgages, they're buying apartment mortgages at discounted rates, lower interest rates, longer amortization. There's a variety of other programs each of these banks offer. Some of those regions have much more robust programs, some are a little more limited. I would encourage you to go to those websites, look at who the list of member banks are, and you'll have a starting point for some of those conversations that you can have about what role can my agency play, what role can my community play in tapping into these resources. A lot of their awards are not huge, and by not huge, like between $300,000 maybe $500,000 that can come as a grant or as a subordinate loan program, but they're very often that last piece of gap funding that's needed to make some of these deals work. And if you can build, can become a reliable source of money for your organization. Now, on the other side of the equation, and by that I mean, the actual income levels that a property can support, and this is much more on the rental side, there is the project-based rental assistance program. This provides a subsidy between what a household can afford to pay at 30% of their income and the cost of a housing unit at a fair market rent. It makes up that gap. So very often when a developer is using the low-income housing tax credit program, or they're using one of these mortgage insurance programs, and just as noted here, it's typically paired with the FHA mortgage insurance program. That's a HUD program we'll touch on in a little bit. This provides additional income to help support the operation of that property, which means the property can support more debt and ultimately helps make the project feasible. If you're in a smaller community, we wanted to touch on some of these programs. There's a single family home ownership program, both direct loans, guaranteed loans, and very importantly, home repair and improvement. And in rural communities, this can be enormously important, where we've got aging housing stock, we've got an aging population. These resources to help make those basic home improvements can be really important. They've got similar programs on the multifamily side, both direct loans, guaranteed loans, and there is a rental assistance payment program through USDA that parallels the project-based assistance available through HUD. On the infrastructure side, these are some of the most common resources that communities go to. Community development block grants are kind of the lifeblood of getting infrastructure and site development done. There are instances where CDBG funds can be used as subordinate loans on affordable housing projects. USDA funds similarly can help offset the cost of the site and infrastructure expense associated with some of this development. And as we mentioned previously, dealing with environmental remediation costs on some of these sites, even getting the upfront investigations done, there's resources at both the federal and at the state level to assist with those costs. So I encourage you to go to those website links that we provided. Here again is the state housing finance agencies with the links to each of their sites. You should, if you're not familiar with these organizations, I encourage you to get familiar with them, know what their programs are. A lot of these states have state-funded programs. And so key resource as you look at housing in your community. These are the links to the state environment departments, their brownfield programs, cleanup programs, site assessment programs can be critical. So want to jump to a couple of examples. We pulled 2 project examples from this region. The first is in a smaller community, decidedly up in Sault Ste. Marie, Michigan. It's a 65-unit development, the multifamily development. So this is serving working families and lower income families in 1, 2, and 3 bedroom apartments. It used the tax credit program, but of these 65 units, only 51 were designated as tax credit units. There were an additional 12 units that were workforce housing units. Again, that definition is typically families that are going up to 80% of area median income. So it's serving a broader range of the community's needs. And then 2 market rate units that have no rental restrictions on them at all, whatever the market will bear. In addition, this property provided more accessible housing by doing handicap accessibility fit out in 7 of the units. Yes, winter. And so the community was able to assemble a site right near its downtown area, put residents near the downtown, which further activated kind of the vibrancy of that area. It already had existing infrastructure because it was near the downtown core, and it put residents in a much more walkable condition, which in this cold weather environment, kind of an added benefit. The property was also LEED Gold certified, so there was a lot of additional work put into the energy efficiency and the weatherization of this building. And because of that, the utility expense for residents was driven down, and that helped with the affordability as well. One of the nice things this development included was some ground floor commercial space, a small market with fresh food, and there's actually direct access from the residential unit right into the marketplace. So residents didn't even have to go outside to go to the market, which is kind of a nice amenity. As we'll see, 85% of the funding came from tax credit equity. Again, the sale of credits, in this instance, through MSHDA, awarded to the developer, who then sold them to an equity investor. And that equity came into the project to make it viable. And this is a project that was paired with those project-based rental assistance vouchers. So these vouchers don't travel with the tenants, they stay with the building. And so the developer and the lender and investor have the confidence of knowing that so long as the property stays in compliance, there's a level of subsidy that those units are going to receive. And that really sets a stable level of rental income that's very predictable. Doesn't matter how much money the tenant that moves in there makes, so long as it's below 80% of the area median income. Again, vouchers serve a broader range of families than tax credits do. So pairing these programs together can be pretty powerful. All of this, all these factors, the energy efficiency of the building, which increases the amount of rent that a tenant can pay because they're not paying it in utilities, and the vouchers increase the amount of first mortgage debt that the property can support, and that then reduces the amount of subsidy that's needed to ensure that affordability. This gives you an example. Again, about 85% of the money that came into this particular deal. I would tell you this is high. Part of this goes to the city providing the land at a very low price. And the developer in this instance, and this is very common, they'll receive a higher developer fee for doing the project, but they've got to put a portion of that developer fee in, and that's this $217,000. If the property performs and generates the projected revenue, the developer would recover that money in no less than 7 years, typically 5 to 7 years. There's actually an IRS rule because of the tax credits around that amount of money that it has to be able to be paid back. But it also ensures that a developer has real monetary skin in the game. And it's one of those important things of kind of aligning business interests with the public policy interest. So let's look at sorry, I jumped there. There we go. This is a project in Chicago. Interestingly, it's not a big project, but I include this because I think it's a really important example. This is a pretty unique project in that it's a scattered site development. And a lot of the affordable housing developments you'll see are all on one site or on contiguous sites. And there's challenges with managing a scattered site development. In this instance, these two neighborhoods, Humboldt Park and Logan Square in Chicago, were facing a lot of issues of dilapidated housing, vacant lots where houses used to exist and had been partially demolished or demolished, and they really needed to knit the fabric of the community back together. So they went in and identified vacant lots and identified homes for renovation, and use these funding programs to create scattered site, multifamily rental development throughout this neighborhood. And this link is actually active. This is an AIA award with HUD that was won. Again, housing accessibility for folks that are physically impaired. In the new construction units they created, they were able to achieve higher levels of accessibility for those families. And the pictures you see are actually the infill of the exact projects built in Chicago. So these aren't just stock photos. These are from the development. So again, scattered site, it did both new construction and renovation, which is also unique. And by tapping into those existing communities, these neighborhoods were already on public transportation lines. And so in Chicago, particularly important with traffic and access to workforce, the ability for somebody to get on the rail system, to get on the bus system and get to and from work is critical. And so reestablishing housing in these neighborhoods was a key strategy. As we pulled this example from Chicago, I think you could lift this example and apply it in a much, much smaller community where you've got vacant lots, where you've got dilapidated older housing, and do the same kind of infill. So what you see here again is the LIHTC equity, 14 million of the $19 million total cost, a relatively small in proportion amount of private mortgage funding, and that speaks to the level of affordability. The property is just not generating a huge amount of rents, but you can see the quality of housing, the quality of renovations having a big impact on these neighborhoods. And then, as is often the case, multiple loans, so private philanthropic loans, IDA making a loan here, the Illinois Housing Development Authority, as well as state tax credits. And again, you see deferred developer fee, and there's that home loan bank grant. In this instance, $686,000 came in. It's designated as a grant, but I would almost guarantee you that this was actually structured as a subordinate loan. The problem with making a grant to a private development is that it becomes taxable income. So the way the home loan bank grants typically work is that it's a grant that will go to a community organization or a city agency who will then in turn lend that money to the affordable housing developer as a subordinate loan. If the property is able to pay some portion of that loan back over time, then that entity has program income that they can put into future development initiatives. But it's important to see, and to kind of tie this back, how a project like this works is with the community support necessary to go out and get that home loan bank grant. And all of these programs are going to look for that consensus building activity. They're going to look for a community process to know that the community is supporting the effort, and then to make contacts with private philanthropy and to make this project a priority from a funding standpoint. Those are all critical roles that the community agency, in this instance, the Illinois Facility Fund, play in making a development like this work. So I just take a moment and kind of recap. As we started the presentation this morning, we talked about the gaps in our housing supply and availability. And it's just critical that you undertake the analytic work in your community to understand where those gaps exist. Is it senior housing? Is it special needs housing? Is this multifamily? Is it for sale housing? And then what is the demand within that segment of the housing market? Because your ability to quantify that is going to be information that a developer or any of these funding agencies want to see as part of getting involved in a transaction. And then understanding those resident income levels. It'll tell you what programs you can tap into and also what kinds of rents are reasonable to achieve in your community. Based on that, you can formulate a strategy, look at your organization, think about the challenges you're facing in your community, and figure out, is there a role here my organization can fill? Is there an organization that with the right technical support or with a private sector partner we can fill? And then put a strategy together. Oh, sorry, looks like
It's okay, you're still sharing the right screen.
Okay, is it still good? Okay, good. What are the resources I can put together as a community to fill those needs? I think I've got to be able to advance. Yeah. Give me 1 second. I have a little technical glitch here, sorry. So that I can move forward with implementation. And that's about putting together the technical resources, the financial resources, and most frequently, the way this gets accomplished in most communities is putting out that developer RFP, but being clear about what public resources can be brought to the table and what funding resources your community is going to expect a development partner to tap into, like the federal mortgage insurance programs. Finally, all of that gets captured in a development agreement, lays out the rules of the road, roles and responsibilities, what the developer is going to do, what the community is going to be willing to support, how everybody's going to work together to accomplish those housing goals.
We've got a question in chat.
Okay, sure.
Someone in chat asked, what is a reasonable deferred developer fee as a percentage of the total financing? I assume that would get captured in that development agreement you were just referring to. What is a reasonable percentage?
It's not so much a percentage of the project developer fee. So developer fees in most tax credit transactions are between 9 and 15%, and that seems like a big range, but there's a wide array of complexity of deals, some that have much greater risk, some less risk. So of that, if you start with total project cost, roughly, let's just say 10% of that is developer fee. Of that 10%, so on a $10 million transaction, that'd be $1 million fee, about $100,000. So about no more usually than 10% of that total developer fee. The caveat is that there's actually a calculation that has to be done based on the net revenue of the property, because the IRS will not treat that developer fee as real debt unless it can be repaid within a certain period of time. So it's important to know, I'm trying not to get too far in the weeds on all this. I'm giving you some rules of thumb, but they're just that, the rules of thumb, and there's more detailed tax rules that apply to how that actually has to be structured. That rule of thumb, about usually no more than 10%
Of the total developer
of the
fee.
total developer fee gets deferred. That at the most, yeah.
Okay, thank you.
This last slide, these websites have some of the best compilations I've run across of different information that really cover the gamut of things that we talked about. A lot of them also talk about federal policy, upcoming funding programs. HUD Exchange is just a wealth of information that's out there, but these are good organizations to know about, resources to tap into.
Great. And again, as if you'll check your chat, the links to this presentation and the slides, a PDF of the slide deck is available on Region 5's website, and those links are in the chat.
So we're happy to take some additional questions. If you've got a longer question, feel free to maybe raise your hand or put a question in the chat.
So we have another question in chat. What is the outlook for layering infrastructure funding with housing funding?
So if I understand your question correctly, I think it's very common that you would be able to get some community DA community facilities funds and use those dollars to complete the utility infrastructure. Usually that work is kind of out in the public right of way. Anything on site is the housing development, but you can absolutely layer those subsidies. Depending on the nature of funding that you're using, it can trigger what's called a subsidy layering review if you're using multiple sources of HUD funding. So if you've got home dollars going in and you've got community development block grant dollars, HUD has a standard that sets an economic value on a per unit basis by market for the total amount of subsidy that can go in. And they look at unit size, unit numbers, all of those things. So there can be an actual review that could limit that amount of money.
Great. We have someone with their hand up.
Yep.
Would you like to, can they unmute themselves, Emma?
Yep, Mary, if you want to go ahead and ask your question. You'll just need to unmute yourself.
Okay, can you hear me now?
Yep.
Yes.
My name is Mary Balkema. I'm from Kalamazoo, Michigan. We're the only county in the state of Michigan that has levied a housing millage that generates about $7.5 million a year. So we're trying to obviously build affordable housing to scale, but there are some issues like with the LIHTC, with the increase in interest rates, there's still a gap in the financing on the projects. And then FEMA, in their wisdom, just redid the flood maps, and now some of our projects happen to be in the flood zone. And so everywhere we turn, there always seems to be an issue. And we've backfilled some of these projects with ARPA funds, but you have to have that money obligated by 2024, and that date is going to come up faster than folks realize. So I like what you're saying, and there is a lot of resources, but there also still are significant gaps in the projects we're trying to get to the finish line.
No argument here at all, Mary. These are very difficult transactions to put together. And there really are no panaceas out there. The one thing that I've seen help some of these issues, and it doesn't help the near-term problem, it's more the long-term problem, but community-wide infrastructure, stormwater management, doing some of the community-wide assessments and cleanup on brownfields can, over time, create more developable parcels. There's a lot of good money coming down the pike. It's out there, it's approved, but it's just now making its way through the federal agencies under the BIL legislation that's out there. So I would really encourage you, and these sites will talk about some of those funds and some of the other links in the presentation, but the work we're doing around the country right now is trying to help communities in your exact circumstance zero in on those specific funding resources that are out there. And often you've got to be creative. So if you've got to build some street infrastructure in this area, but you've got a flood zone management issue, can you use some of those transportation dollars to get some of that storm infrastructure in? There's no quick answers, there's no panaceas, but good for Kalamazoo. And as a WMU grad, go Broncos. Glad to hear that you all have put those kind of resources in place to support housing in Kalamazoo County. That's awesome.
Thank you so much.
We have another question from Jenny. How can a region or community find out more about EPA's technical assistance regarding the affordable housing studies and market analysis? Jenny, I'm going to encourage you to get in touch with your brownfields contacts at EPA. Brittany Nadler is on this webinar. I think Jim Vanderkloot attended also. There is, I don't know if you're familiar with the TAB program, Technical Assistance to Brownfield Communities. Depending on what state you're in, there may be a state point of contact, or you can contact KSU TAB, serves this region, and you can request some technical assistance directly through TAB as well. Again, available to communities and nonprofits. And Brittany, feel
Don't see any other hands raised, but if anyone wants to ask their question verbally, please feel free to raise your hand.
Okay.
okay.
Well, we appreciate everybody joining us this morning. Again, the slide deck with the active links is posted on EPA's website, and that link is in your chat. If there are no other questions at this point, I think we can
Wrap it up.
yeah, we'll wrap it up, give everybody a few minutes back. We appreciate your time this morning.
Yeah, nice job, Tom. All right, thank you all.